What scares people the most when buying a house and getting a mortgage? So many questions. How much do I have to pay each month? Am I getting a good interest rate? How much interest will I pay over the life of the loan? And what about closing costs and those hidden fees? Today, we're going over the single most important document in the home buying process, the loan estimate. If you're in the process of getting a mortgage right now and you want to find out if you're getting a good deal, you can use this free loan estimate comparison tool from Mable Loans to find out in just 90 seconds. I personally developed this and it's already helped a bunch of people get a better rate on their mortgage. On average, buyers are using this loan comparison tool to save $9,000 on their mortgage. Answer a few quick questions, then upload your loan estimate to instantly pit your loan against 100 of the nation's top lenders using our unique loan comparison software. And in just 90 seconds, you could get a better interest rate and save thousands in upfront fees. We're going through line by line and showing you the one thing you really need to look at when comparing lenders to make sure you're getting the best deal. So before diving into the loan estimate, let's talk about where this all came from. So about 10 years ago, the government stepped in to provide some more clarity, transparency, and most importantly, empowerment to potential home buyers. They created two standardized documents, the loan estimate and the closing disclosure. And I think this is one of the few things that they really got right. You're really protected with these forms against two big concerns: being perfectly clear on your bottom line, which is your monthly payment, and your upfront cash that you're going to need to close. And secondly, ensuring that there aren't any last minute surprises where you show up to closing and you're pressured to sign something that doesn't match what you were expecting. Which brings us to the timing and delivery of the loan estimate. There's a clock that starts ticking once you submit your loan application. The loan application is officially submitted when your lender has these 6 key pieces of information: your name, social security number, your income, estimated property value, and loan amount. The last is the property address. So when you initially get pre-approved, you'll provide the first 5 items to your loan officer, but the property address comes once your offer is accepted and you have the contract to buy a property. By law, lenders have 3 business days to send the loan estimate. So let's take a look and you'll see first thing on page 1, the date issued. So this signifies the day that your loan estimate was generated, and certain timelines are going to hinge off of this date. Then you've got your applicant's property address and sale price. You want to make sure that your name is spelled correctly and the sale price and property address match what's on your contract. Then you've got your loan term. And so typically you're going to have 30-year fixed, but it could be a 15 or even a 20-year. Then you've got loan purpose. We're talking about purchases today, but if you're refinancing, you would also receive this loan estimate. Product, most common is going to be fixed rate, but you want to make sure you check this because it could be an adjustable rate mortgage, which means that interest rate could go up after a certain period of time. And then you've got your loan type. Most common is going to be conventional FHA and VA, but it could be another type of loan like a USDA loan. Then you've got your loan ID. This is also known as your loan number, and that's going to be the unique identifier for the life of your loan. Below that, you've got your rate lock, and this is where you'll see if your rate on your loan estimate is locked in. If it's not locked, then that means your rate is floating, meaning that you're actually exposed to deteriorating market conditions. So that means that if the market gets worse, your rate could go up or some of the costs could increase. So if your rate is locked, you'll see that date there. The rate should be locked on or after the closing date that's in your contract. So then we've got loan terms. The loan amount is the amount that you're borrowing, and that is your sale price minus your down payment is going to equal to your loan amount. And then you've got your interest rate here, and then your monthly principal and interest payment. Right below that, you're going to see if any of these amounts can increase after closing. Now, typically with any traditional loan, that's going to be no. If you have a fixed rate loan, none of these amounts will increase. There's not going to be any negative amortization and generally no adjustable rates. So with any conventional FHA or VA loan, you will not have prepayment penalties, which would be a fee for paying off your loan or refinancing the loan early. And then there's also a balloon payment, which means you would pay interest only for a certain period of time. And then after that interest only period, the whole balance would become due. You would either pay it off or refinance that mortgage. So typically, you're not going to see any of these special features with a traditional loan in the market today. Next, we're going to get into the two items that I refer to as your bottom line. So that's going to be first your projected payment. So that includes your principal and interest, and then possibly mortgage insurance if you're putting less than 20% down on your purchase. And if your payment includes escrow, so that is where a portion of your property taxes and homeowners insurance are paid each month to the lender, and then the lender will take care of paying those bills when they come due. And then below that, we've got costs at closing. The estimated closing costs will include amounts financed, which you'll have an upfront mortgage insurance premium on an FHA loan and a funding fee on a VA loan that would be included in that amount. So those would be financed and not necessarily something that you would be required to pay out of pocket, and typically not something that you would pay out of pocket. And then you've got your estimated cash to close. And this is the amount that you're actually going to be writing the check for on the day of closing. Every cost associated with your loan is going to be itemized right here on the second page of your loan estimate. So let's make sure we understand each one of these costs so that there's no surprises at closing. The first thing that you're going to see here is your loan. In your loan costs in section A is origination charges. So that's going to be any fees charged by the actual lender. So you've got application fee, underwriting fee, processing fee. Then you'll have something called points or discount points, which is a percent of the loan amount that you're being charged specifically for that interest rate that you're given. So you can pay more points to get a lower interest rate, or you could take a higher interest rate in exchange for what's called a lender credit. And that lender credit can be used to offset some of these other costs. So if your rate is locked, then that means these fees cannot change unless there's some significant change in circumstances, like a change in the loan program, or if you were to request a different rate. In either case, the lender would be required to provide you with an updated disclosure within about 3 days of recognizing any of those changes. Now, like I mentioned earlier, that one thing that you want to be looking at when comparing one loan estimate to another from two different lenders, this is going to be that section. So this is the section, the origination charges is what you would use to compare a loan estimate with multiple lenders, because these are the actual charges that are going to the lender. So it wouldn't be all these other third-party fees that you would be looking at. Some lenders can get a little bit tricky with that stuff. You would want to look just to section A and the origination charges and the interest rate to see which lender is giving you the best deal. Moving down to section B, these are the services that you cannot shop for. So these are third-party services that are essential for the loan, and you can't shop for them because the lender is actually going to be the one that's going to request those. So you've got your credit report fee, flood cert fee. That's going to determine if you're in a FEMA flood map zone. If you are, then you would actually be required to have an additional flood insurance on the property. And then you've got your appraisal fee. So this is to confirm the value of the home. Now, lenders use a third party to select an appraiser to prevent anyone from trying to influence the value. You can get an appraisal independently on your own, but just know that the lender is not going to be taking that into consideration when looking to determine the value of the property. Then you've got the services that you can shop for. You've got a pest inspection fee, and that's going to be checking to make sure there's not any termites or pests in the property. A survey fee, that's going to confirm the actual boundary lines of the property. Pest inspection and survey may or may not be required in the area that you're purchasing in. So then these charges that say title next to them, these are going to be the third-party settlement services. So either with a title company or an attorney, which you can shop around for. Now, in general, we see most of these services are going to be pretty close to each other in price. And so you could potentially save a little bit of money by shopping around, but in general, we don't see one company to the next being drastically different on their charges. So the title search, this is going to ensure that the property has a clear title without any liens that can be transferred. And the lender is going to be insured just in case anything does come up down the road. And someone's making a claim on the title. So that's what the lender's title insurance is going to be for. Now, again, I wouldn't be too concerned about this because we usually don't see any big differences in fees between one title company to the next. Now, on the right side of the loan estimate, page 2, we've got other costs. So the first thing you're going to see is taxes and government fees. These are mandatory and usually set by the state or the county. And examples would include recording fees, or what we generally are going to refer to these as your transfer taxes. Now, depending on the state that you're buying in, you may or may not actually have transfer taxes. Right below that, we're going to have the prepaids, and that's going to be expenses that you pay in advance. The main one being homeowners insurance premium. So the first year's premium is always required to be paid right up front. And then you've got prepaid interest, which is the interest between your closing date and the end of the month. So when you close on a home, you're always going to skip a month before you make your first payment. So if you were to close in October, your first mortgage payment would be due on December 1st. So closing on October 15th, you would have prepaid interest of 16 days. That's from October 15th through November 1st. Right below that in section G, we've got our initial escrow payments at closing. So if your mortgage has an escrow account for taxes and insurance, the lender will sort of pad that account with 2 or 3 months of cushion to ensure that there's enough to pay the tax and insurance bills when they come due. Now, each month on your actual mortgage statement, you're going to see how much money the lender has in that escrow account. Remember, this is your money. So if you pay off the mortgage or refinance, the balance of that escrow account is refunded to you. Section H, we're going to have other costs. So you'll typically have owner's title insurance listed here. The owner's title insurance is in the event that there's a claim against title, just like the lender's title insurance. But the owner's title insurance is optional. So you can consult with your title company to see if that's something that you really want to buy. In section J is where you would see if you have any lender credits that can be given to offset some of those closing costs. Then right below that, you're going to have calculating cash to close. This takes all the above costs, subtracts the deposits that you put down at closing and any seller credits that you've received, and gives you that net amount that you're going to need to bring at closing. Page 2 is dense, but it's super transparent. Every single penny that you're going to be spending on this mortgage is going to be listed here. So make sure you review it closely and that you understand it thoroughly. If there's any questions at all or anything you need clarification on, reach out and talk to your loan officer about it. So now let's take a minute to talk about subsequent loan estimates and any adjustments. If certain triggering events happen, such as a decision to go from floating your interest rate to locking it, change in loan product, or if new information emerges affecting the settlement charges, lenders would need to reissue that loan estimate. Can your loan estimate change? Yes, but there's strict parameters. For instance, fees directly controlled by the lender cannot increase unless there's a significant event like a change in loan product. However, third-party services that you can shop for can change without redisclosure. So turning the focus to page 3, this is one of the pages that's often overlooked, but it's an important guide when you're making a decision on a loan. The first thing that you're going to see right here is comparisons. So this section essentially is a tool that's been designed to help you make an apples to apples comparison with other loans. And here's how it does that. The first thing is going to be what you'll see is in 5 years. So in the first 5 years, it's going to show the total amount that you'll have paid, including principal, interest, and other costs that are all rolled into the loan. So this gives you an idea of the short-term costs of this loan. Then you're going to have your annual percentage rate, and this represents the total costs of the loan annually. So this is taking into account the actual interest as well as any fees. So this can be critical when you're comparing loans, as a lower interest rate might actually come with higher fees, resulting in a higher APR. Below that, you've got the total interest percentage, or the TIP. This displays the total amount of interest that you'll pay over the loan term as a percentage of the total loan amount. So it's a quick way to grasp just how much this loan is actually going to cost you in terms of interest. Right below that, we've got other considerations. So beyond the numbers, you need to be aware of several key considerations that might impact your decision. First thing we see is the appraisal. And this reminds you that the lender will get a property appraisal to determine the value. And if that appraisal comes in less than the purchase price, you may need to either renegotiate the price with the seller or actually come to closing with more money to pay the difference between that appraisal value and the sale price. So below that, you've got assumptions, and that is a feature of a mortgage where you could actually assign your mortgage to a new buyer. This is available on FHA and VA loans, and in a market with rising interest rates, this can be very, very attractive to a buyer. let's say that you have a 5% interest rate on your current FHA or VA loan, and the current market is at 7%. You could market your property saying that I have a 5% assumable FHA loan, which would be really attractive to potential buyers. And right below that, we've got insurance. So if you fail to maintain property insurance, the lender might purchase insurance for you. And generally, if they do that, it's going to be a much higher cost than if you were to just go get it on your own. So always make sure that you're maintaining homeowners insurance on your property. Then right below that, you've got late payments. So this will detail the repercussions if you were to be late on your mortgage. And late on a mortgage is typically if you pay more than 15 days late. In those events, you would actually incur a fee. So they're just letting you know that here. And then you've got a quick note on refinancing. And this is just a reminder that there's actually no guarantee that the lender is going to refinance your mortgage. This usually doesn't come up as an issue, but the lender's just kind of letting you know their rights, that there's no guarantee that they will refinance your mortgage. And then this is a big one for a lot of people, which is the loan servicing. So right here up front, the lender's letting you know whether they intend to actually service, meaning collect the payments on your loan throughout the loan term, or if they plan on transferring those service rights to another company. So a lot of people get worried about this, saying, hey, is my loan going to be sold? In reality, the only thing that you have to deal with your loan servicer is just making your payment every month. So who you make that payment to shouldn't really make a difference. Lenders are required to give you plenty of notice on when they're going to be transferring your loan. So you'll have plenty of time to make arrangements to set up making those payments to the new servicer. Finally, on the bottom of your loan estimate here, you've got loan acceptance. So this indicates that you're not obligated to accept this loan even after receiving this loan estimate. By signing here, you're not committing to the loan. Instead, you're just acknowledging that you've received the loan estimate, which is going to start the clock on certain timelines of your mortgage process, and mainly allowing the lender to go ahead and move forward with ordering that appraisal. Page 3 is about understanding the bigger picture here with your loan plus your rights and the lender's rights and the key factors that could come into play. The loan estimate is more than just paperwork. It's a tool to help you understand the costs and features of your loan and to compare with other offers. I believe that knowledge is the first step to power in real estate, and I hope today's video has given you more clarity and confidence. Remember, buying a home can be a scary decision, but with the right information and guidance, you've got nothing to be afraid of. If you have questions, feel free to reach out to me directly. And until next time, wishing you happy house hunting.